I don't know if you saw, but on the top of the show, I put out some data for the overall market in terms of what positioning in stock futures, etc., is looking like, and just asking the question whether there is a bit of complacency building up. I mean, the basic thing I looked at is retail positioning in single stock futures compared to FI positioning in single stock futures. And we are basically back to levels we were in January of 2018. Any thoughts, Dhiraj, in terms of what's going on?
Good morning, Prashant. Clearly, the rally is spreading and is becoming even more broad-based, as reflected by small cap index touching all-time highs. Now, we expect second-line stocks or value, including the likes of capital goods and engineering, utilities, manufacturing sector, select PSUs, will continue to get recognized in terms of relative undervaluation. Incidentally, earnings of capital goods companies are at cyclical lows and can improve significantly as capex cycle picks up. Now, corporate capex is definitely looking up again after many years of continuous decline. Now, this is driven by PLI-linked investments or commodity upcycle, and even growth in emerging segments like data centers. So new capex or investments are actually being done in sectors like cement, autos, pharma, consumer electronics, and chemicals. So we believe that corrections in market are likely to be short-lived, given that other avenues like fixed income, real estate, they yield lower returns versus equities. And besides, with lessons of last year, any panic reaction in markets will be bought into. So we're not perturbed by some element of complacency, higher valuations. That is always the nature of any bull market. But to our mind, the correction will be short-lived. There's a structural foundation of this bull market is very much on, with low interest rates and earnings revival. And despite near-term cost pressures on account of second wave of COVID-led disruption, the overall market valuation is no longer cheap and days of easy money are behind us. It's better to have a buy and hold approach with a 3-year perspective. But we don't believe that the corrections will be too sharp, despite some element of complacency in the market that you're talking about.
Dhiraj, morning. This is Reema here. You manage an emerging champion fund where you invest in small and mid-cap companies which have great potential. Can you tell us about the latest additions to this particular fund? Which are the small and the mid-caps that you've bet on and why?
The space in the universe of small cap is too huge. I mean, in some of the sectors, you will not even find it in the larger companies. So our portfolio structurally is exposed to many sectors. This includes agriculture, for example, which includes crop protection companies, seed companies. I think that's a very sustainable kind of a theme, given the farmer wants to improve crop productivity or yield. Specialty chemicals, we have been talking about that in the past, which are the building blocks for agrochemicals, pharma, flavors and fragrances that are in the essential category, are a good part of our portfolio. And despite the valuation rally in valuations expanding in specialty chemicals, we believe that this sector is actually witnessing huge amount of capex, almost to the tune of 4,000 to 5,000 crore over the next 3 years itself, which means that the earnings will expand out of the capacity creation or new fresh capacity creation by many companies in the specialty chemicals. Besides, we like pharma and healthcare, engineering and capital goods. Cement is a good proxy to infra and housing investments. Select technology and digital platform companies are the ones that we have added because we believe cloud migration could be a multi-year theme as there is an acceleration to digital. We also like select companies in the food processing or the ones who may benefit from a government's ethanol blending program. So net-net, Reema, we believe that there are many structural sustainable themes to play in the small cap, whether it is led by import substitution or thrust on local manufacturing, ongoing digitization wave, shift from unorganized to organized sector, increased automation, renewables, green technology. I think there are plenty of structural themes that one can play in the small cap basket.
Is there valuation comfort though across these names, Dhiraj?
Prashant, can you repeat? Sorry, I didn't.
Is there enough valuation comfort, margin of safety across these themes in the small cap space?
Prashant, you're right. I think valuations in many cases have gone up, but you'll have to spot it because many of the small caps are still under researched and they are underappraised. So our job of a fund manager, which are in the small cap, in the mid cap space, obviously has to be selective and navigate because there are a few thousand listed companies in the market and you can't expect all of them may have, exceeded kind of valuation. Some of them may have run ahead of time, and probably you'll have to play out with the fact that let's hold them for 3 to 5 years because earnings potential is still very strong. In some cases, you may not touch it because of they may not be sustainable earnings. But many of them are still underappraised, under-researched, and as a result of which they are undervalued. And that's why we are selectively betting on.